All right, so let's look at what we did last time. What I'm going to do is walk you through, we pretty much have already finished this project. So let me walk you through what I've set up, and we'll redo the numbers. So we got to know where our starting point is. So we're doing intrinsic value analysis, which means we're going to set this up for where the market is today, where option prices are today, set up our strategy, and then we're going to use historical returns to figure out if it's a good strategy or not. So what's the current level of the S&P 500? So we'll go to the we'll go to Yahoo Finance. Yahoo Finance says 2081, so we'll put that in as our starting point. I'm going to do a portfolio that's $1 million. You can do 10 million, 100,000, whatever. I'd recommend you make it be at least $1 million, because less than $1 million you start having trouble with rounding on the number of contracts. So the S&P is currently at 2081. I've got $1 million portfolio. I'm going to buy enough put contracts to perfectly hedge that portfolio. So if you remember that formula, we take the value of our portfolio, $1 million, and divide it by the current S&P 500 times 100. And that means we need 4.81 contracts. We can't do 4.81 contracts, but we can do 5. So I'm going to buy 5 put contracts. And then my strategy is to sell some call contracts. I'm going to buy 5 put contracts that completely hedge my portfolio, and then I'm going to sell 2 call contracts. I'm going to use the CBOE to get my prices. So what's my strike price going to be on the puts? I want to protect myself from about a 10% decline. So let's try 1875. In the calls, I might do 2100 for my calls. So 1875 will go about a year out. So I'm going to do, let's say March 2017. We'll see. It'd be nice if we could go to April 2017, but there's not a contract there. So we'll look at the Chicago Board of Trade. So you go to cboe.com, do quotes and data, and delayed quotes. What we're looking for is the SPX. So you type that in and submit. Over here in expiration, we're going to go out to March 2017, so we're off a little bit. We want all contracts. So view the chain. Here's our calls, here's our puts. So March 2017, I would do the, well, let's go out to the 331, get us as close as possible. So you can pick whichever one you want to pick, but we want to get as close to a year as we can get. So 1875, a year out, the price, use the higher price, right, because we're buying. So use the ask price, 81.80. So I'm going to type that in, 81.80 is my price. So the cost of my puts is going to be 5 puts times 81.80 times 100, because each contract is for 100. All right, so it's going to cost me $40,900, which is pretty expensive, very, very expensive. Given that we only have $1 million portfolio, that's almost 4% of our portfolio. My strike for my calls is 2100. So go and find 2100 on the calls. Here's 2100 on the calls, so we'll receive 106.40. But we're only doing 2 calls, so you take 2 times 106.40 times 100, and that's how much we'll get for the calls. Any questions up to that point? So at this point, you're just setting up the structure. All right, so everybody sees how I got the 5 calls. Very simple formula. The 2 is just my strategy. I only want to do about 40%, as many calls as I do puts. All right, now the columns. What columns do you need? This is one thing we changed from last time. Options are price only. That's how they're recorded, is price only. So what I did is I went and got the S&P. Over here, we got this last time. I got the S&P's total return. I think we used a Vanguard mutual fund. We used a Vanguard mutual fund to get these returns. I don't know if you remember that, but we got those returns. Look at those videos from there. So just go get a Vanguard mutual fund and use the adjusted price, right? And I'll give you the total return. And using that adjusted price, that's then going to tell us how the S&P did. So if the S&P started at 2081 and the total return was negative 855, you actually don't need this column anymore, but that would imply that the adjusted return after a year is going to be 1903, then 19%, 17%, 3%, 22%. But what I did here is I just went and got the SPX and did the exact same thing and just got total returns on an annual basis. You just take the December number divided by the previous December number minus 1, and that tells you the return for that year. But that's price only. Here I do need the strike. I need to know if that S&P price was down 9.73%, where would the S&P have been at the end of the year? So 2,081 times 1 plus that change is 1879. So here, these are the actual values that my options are going to be priced off of. Y'all see that? Because options aren't priced off of, if you don't include dividends, and the options is pure price. So you can get that from Yahoo Finance, real easy to get. Just in Yahoo Finance, there's the S&P right there. You can get historical prices. I put it on monthly. You can get the monthly prices, and then I'll download that to a spreadsheet. We don't need 2016, so I'll take the 2016s out. I just want the close. Here, the adjusted close and close don't matter because there are no dividends, but anyway. And I'll show you how I did it. You can do it however you want to, but the way I do it, there's probably several different ways to do it. I just do equal year and go get the year and copy the year down. So there's my ending value for 2015. Then on the other one, it's going to say if the year here equals the year there, they give me a 0, otherwise give me a 1. And I copy that down, and when I do that, I'll get a 1 every time it's December. Otherwise, I'll get a 0. And so what I can do is copy and paste that as values, and then I can sort this. Well, I only need it back to 1981, so let's get rid of everything before then. Back to 1981, maybe 1980. Yeah, you need 1980 because you got to get the change. So I'll go back to 12/1980, and then I'm going to sort by that last column. Then I'm going to sort by the first column. Last column, I'm going to sort from largest to smallest. And you see when I do that, move your 2000. I messed up 2015. I shouldn't have done that, but. But when you do that, you have all your 1231s together. I messed up one, though. Sorry, I shouldn't have done it the way I did it, but. And so when you do that, you should have all your Decembers lined up. And so your price return is just ending divided by beginning minus 1. And so that gives you all your price returns for the year. However you want to do it, you just got to get somehow, in this column, you got to get the change in the price. That's the easiest way I know how to do it. There's probably other ways. You unfortunately in Yahoo Finance can't bring it in annually. You can only bring it monthly. So you got to somehow get all those non-Decembers out of the way. All right, so you need an S&P 500, that's price only. You don't need, actually, this column here that we created last time, but you do need the S&P 500 total return. So you need a price on return to get the strike, get the actual ending value, and you need the total return including dividends. All right, questions on those four columns? You see why we need them? This is going to tell you the return of your portfolio, and this is going to tell you what your options did. All right. I sent you the bond return, so I just put those y'all get that file, right? The annual bond returns, so you have that. All right, so let's stop it there. Take any questions.